Why early year operational stress signals matter more than year end misses. Executives are accustomed to managing misses at the end of the year. Variances can be explained, budgets reset, and corrective actions folded into the next planning cycle. What is often underestimated is the significance of stress that appears at the beginning of the year, when options are already constrained and recovery windows are narrow. Operational strain is surfacing earlier than many leadership teams anticipated. Facilities, energy systems, and infrastructure-dependent operations are showing signs of pressure in Q1 that were expected later in the decade. The issue is not the severity of the disruption, but its timing. Early stress changes how and how quickly risk materializes. Why Q1 stress carries more strategic weight. Late year underperformance typically arrives after much of the year's value has already been captured. Early year stress arrives before organizations have had time to generate margin, flexibility, or momentum. Capital plans are approved, energy contracts are locked, maintenance deferrals have already been assumed. What remains are short-term workarounds that preserve continuity but often weaken resilience. Research from McKinsey & Company on operational resilience and capital productivity shows that organizations that wait to address operational stress often face higher costs and fewer viable response options once performance begins to deteriorate. Early stress rarely stays contained. Operational stress does not remain an operational issue for long. What begins as a facilities constraint or energy reliability concern quickly cascades into cost volatility, safety exposure, sustainability trade-offs, and reputational risk. The cascade is often subtle. Teams quietly adjust uptime thresholds. Redundancy is reduced. Temporary exceptions become routine. Sustainability targets are deferred to preserve reliability. None of these decisions are framed as strategic shifts, yet together they reshape enterprise risk profiles. Analysis from the World Economic Forum (BOF) has repeatedly shown that operational disruptions now cascade rapidly across financial performance, regulatory exposure, and reputational risk, often outpacing traditional organizational response structures. Early stress accelerates that cascade by compressing decision time. Why early signals are easy to miss. Early year operational strain is often dismissed as noise. Weather events, isolated equipment failures, or regional grid disruptions can be rationalized as temporary. Individually, they may be. Collectively, they can signal a deeper structural mismatch between strategy and operational capacity. Facilities and operations teams usually see these patterns first. Yet escalation pathways are rarely designed to translate operational signals into enterprise-level risk intelligence. Data is fragmented. Issues are categorized as technical rather than material. By the time patterns register at the executive level, options are already limited. Research from Gartner on enterprise risk and operations leadership shows that many organizations continue to interpret early operational warnings as technical issues rather than as indicators of broader enterprise risk, delaying strategic response. What executives should be watching now. The most important early year questions are not about progress against targets. They are about tolerance. Where are systems operating beyond planned margins? How much downtime is now considered acceptable? Which assumptions are being quietly overridden to keep operations running? These are not operational details. They are leading indicators of strategic resilience or fragility. Why early attention changes outcomes. Organizations that treat early operational stress as intelligence rather than inconvenience gain time. They can revisit assumptions, resequence capital, adjust procurement strategies, and recalibrate expectations before constraints harden into liabilities. Analysis from Deloitte shows that early year volatility is increasingly influencing executive decision-making by exposing structural weaknesses before mitigation plans are fully in place. In 2026, the companies best positioned to adapt will not be those with the most ambitious strategies on paper. They will be the ones that recognize early operational stress for what it is, an advance warning. The year does not begin in the boardroom. It begins in the systems expected to deliver. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.